What if I told you that the secret to retiring before 60 isn't about accumulating millions of dollars? It's not uncommon that people reach out to me convinced that they need to work until their mid 60s because that's what all the calculators told them. In fact, they had these spreadsheets with their projections showing that they needed $2 million just to feel safe. But oftentimes, when we dig deeper into what they actually wanted to spend, and more importantly, how they wanted to live in retirement, everything changes. And they quickly discover that they've been chasing the wrong target entirely. So in today's video, I'll be revealing why the secret to retiring before 60 isn't just about how much you have saved, but how building flexibility through cash flow, bridge income, and proactive tax planning can help enable an early retirement even sooner than you thought possible. Let's get right on into it. Here's something that will blow your mind. Most new clients that come to us often could have retired 2 to 4 years earlier than they thought possible. They just didn't know it yet. In fact, what I hear from most people that start working with us is, I wish I knew that sooner. And it's not that they were doing anything wrong, but they were stuck chasing what I like to call the 1 more year trap. They fixate on hitting the 1 million, the 2 million, or the $2.5 million target that some calculator or advisor told them that they needed to hit. Or maybe it's that commercial, the ING one where people used to carry around the number in their hands. I blame that just as much. Let me introduce you to Jim. He's 58 with $1.2 million saved, and every calculator is telling him that he needs $2 million. So he's planning to work another several years just to hit that target because to Jim, saving more feels right. But it's the same discipline that built his wealth that is now the very thing preventing him from enjoying it. In fact, I see this pattern constantly. Someone in their late 50s with a solid portfolio gets stuck in what I call the 1 more year trap. They tell themselves, if I just work 1 more year, I'll feel safer. But 1 more year turns into 2, then 3, quicker than they often realize. And oftentimes, it's those same people that I've shown that they can actually spend more in retirement than they're spending now and still never have to worry about running out of money. See, for most people in this situation, the problem isn't mathematical, it's psychological. We've been programmed to think that retirement is about hitting a number on a spreadsheet. But accumulating money and spending money require completely different skill sets. And if you're watching this video, chances are that you were an expert at the accumulation phase. You'd spent 30 plus years getting really, really good at saving and growing your wealth. But when it comes to the distribution phase, oftentimes people don't know what to do because actually spending that wealth strategically makes them feel like they're flying blind. And even worse, spending feels wrong. And here's what's really crazy. A lot of people find that spending $2 million is actually harder than it was saving it. So it's clear that chasing numbers can be a moving target that will keep you working for longer. But understanding your withdrawal strategy is key to enabling an early retirement. Let's continue with the same example that we talked about earlier. Jim's 58 with $1.2 million saved, and he's convinced that he needs $2 million. According to his calculations, he needed to work another several years to hit that I feel safe number. But what if I told you that with the right withdrawal strategy, he could potentially retire now and still feel secure in that decision? Here's how. Instead of thinking about one fixed spending amount, successful retirees plan with 3 different spending levels. And when we showed Jim the spending strategy, it changed what he thought was possible. And we break this down into 3 different levels. The first level is your lowest acceptable spend. For Jim, this was $72,000 a year. Think of this as what you need to feel comfortable spending to actually make retirement a reality. This is going to cover your mortgage, utilities, insurance, the basics, the things that you need and actually to be able to live comfortably. And for Jim, he knew he could do this even if markets got rough. But we need to establish this number because we don't want to retire on a razor's edge. The next level above that, or level 2, is your desired spending. For Jim, this was $95,000 a year. And it's what he wants to spend in retirement. This includes things like dining out more often, enjoying his hobbies, doing some traveling, and giving gifts to family. This is because that number is his target spending level. And then beyond that is level 3. This is the maximum spend that the plan can sustain and we still feel comfortable. For Jim, this is about $120,000 a year. And again, this is that maximum amount we'd feel comfortable with while making sure the plan is still on track. This allows for more travel, helping out your children and grandchildren, and discretionary purchases without any worry. But here's the key. It's not just about how much you spend, but when and where that money comes from. Because at 58, he still has several years until Social Security kicks in, and we need to build a bridge that protects him from retiring at the wrong time in order to sustain his portfolio. Here's how we might structure his $1.2 million. First, in bucket one, we want 1 to 3 years of liquidity. For Jim, this would be about $285,000 or 3 years of spending in cash, CDs, short-term bonds, money markets. You get the point. This will cover his essential and comfortable spending for the next 3 years. In bucket number 2, if you want one, this can be your medium-term bridge. So think of it as you cover years 3 through 5. For Jim, this is about $190,000 in short intermediate bonds. This money has time to grow, but also stays relatively stable. And look, if you're not a fan of bonds, you could ignore this bucket and put more into bucket 1. I call this the barbell approach. And lastly, in bucket 3 is his long-term growth bucket. This will be about $725,000 in a well-diversified portfolio of ETFs that's primarily in stocks. And when you break it down, this portfolio was in line with his risk tolerance, his 60-40 that he was comfortable with, but it was framed in a way that he can understand and feel confident bridging the gap with, and most importantly, he felt confident pulling the retirement ripcord earlier, because he realized that it gets even clearer once his Social Security kicks in. Now, depending on his claim date, his Social Security will cover about $36,000 to $42,000 annually, and that dramatically reduces what he'll need to withdraw from his portfolio. For example, if he wanted to spend $95,000, it would only be about $53,000 to $59,000 that he's going to need from his portfolio at a future date. But here's what makes this strategy powerful: flexibility. In good market years, he can spend up to level 3. In tough years, he can drop down to level 1. And in most years, he's comfortable spending and, most importantly, happy spending at level 2. It also gets more clear with time when he can elect to take Social Security. If the market remains up, he may choose to delay. Conversely, if it was down, he can pull the lever and turn on Social Security in his early 60s. This withdrawal strategy gave him something more valuable than waiting to save $2 million. Gave him options and peace of mind at where he was at today. But there's one more thing that keeps most people in their "I'll work one more year" seat, and it's the unknown cost and complexity of health insurance in retirement. Because for a lot of retirees in their late 50s, keeping healthcare costs down before Medicare is essential. But don't let it stop you from retiring. I've seen way too many people who are miserable at work but plan to just grind it out until 65 to get Medicare because they're afraid of what health insurance costs. And most importantly, it's just unknown. But here's the good news. You have options. Depending on your personal situation, you can consider a health sharing organization, private insurance policy, or an HCA plan. And they don't have to cost an arm and a leg. If you decide to go to the marketplace, you could potentially offset the cost of insurance through tax credits. But managing your withdrawal strategy ties directly into your health insurance costs and your overall retirement plan, which we'll get to in just a second. So now that you understand how to bridge the gap for an early retirement, if you need more help with your plan, click the link below to book a call where I'll analyze your specific situation and show you exactly how to pull the retirement ripcord earlier. Now, going back to what I was saying earlier, having the right tax plan is one of the highest impact strategies for optimizing your retirement income, and where most people leave massive amounts of money on the table. Jim's $1.2 million was structured like most people's, about $1 million in his pre-tax 401k, $50,000 in a Roth, and $150,000 in a taxable account. But that $1 million in his pre-tax 401k wasn't actually worth $1 million in spending power. Because depending on his withdrawal strategy and tax plan, it could be worth significantly less after taxes. The difference is how you strategically manage taxes during retirement. When he retires at 58, he realizes that he'll be in the lowest tax bracket that he sniffed out for decades. In fact, he's going to go from earning about $150,000 a year to now having much more control over his taxable income. And for a lot of people in this situation, it creates an opportunity. But it's one that many people miss, because for possibly the first time in decades, they might be able to fill up the lower tax brackets. One of the best ways for this strategy to be executed is in the window between the time you retire and when you take Social Security. This is because your income is lower during those years, especially if you have some after-tax assets as well. This gives us an opportunity to strategically control how much income you're taking each and every year, and whether you're withdrawing or converting up to a certain tax bracket. And it allows you to convert quite a bit more within that bracket since you have more room to the top of it. For example, the lower income during those years gives you the ability to strategically withdraw or convert about $50,000 to $60,000 per year while only paying the 10 or the 12% top marginal tax rates in many cases. See, ideally, your early retirement strategy is structured around this window of opportunity because being strategic and proactive with how you spend your money could potentially save you thousands, if not several hundred thousands of dollars in less taxes paid over the course of your retirement, especially if, like Jim, you have a good deal of pre-tax retirement assets and also some taxable assets as well. But look, retirement is about more than optimizing your numbers. You can sit there in spreadsheet land or in your planning tools and make the most optimal financial plan in the world. But if it doesn't support what's truly important, then I would submit that you plan for the wrong retirement. So what does that mean? I've seen many people run their numbers ad nauseum, but haven't planned on what they're actually going to do with all this time. Someone like Jim took 30 years to climb the corporate ladder, and their identity is completely wrapped up in being the go-to person at their company. The thought of not having that title, those meetings, most importantly, that structure, for some people can be terrifying because retirement satisfaction has very little to do with money once you have enough. It's all about purpose, relationships, and personal fulfillment. And this is what I call the identity crisis of early retirement if you're not prepared. Too many people go from being the guy or the girl at their company to just being you. And for some people, that's liberating. It's more exciting than anything. But for others that aren't prepared, it's terrifying. But the happiest retirees that I work with share these three common traits. The first is they give back, not just financially, but with their time and their expertise. Whether you're mentoring young professionals in your industry or the career that you were in, volunteering for a local nonprofit or your church, or teaching business skills at a community college, there's so many ways to do this. Second is they stay connected. They prioritize their relationships, whether it's spending time with their family that oftentimes they've been too busy for, or reconnecting with old friends, or even building new friendships around shared interests that they have as they enter into this next stage. And many people are excited about finally having the time for their grandkids, their kids, or even just rekindling friendships that they've put to the side during their career-focused years. And lastly, and this one's really important, is they keep growing. They pursue learning and experiences that they've never really had the time to do or pursue to the level that they wanted to during their career. Whether it's learning something new, traveling somewhere that you've never been to, or altogether challenging yourself to start something different, these are the people that, at least in my mind, seem the most fulfilled. The key is planning for this before you retire, not after. You need to know what you're retiring to, not just what you're retiring from. So now that you understand the complete framework, let's look at the comprehensive early retirement strategy and how it actually works. So how did Jim go from I need $2 million to I can retire with less? Well, he understood that retirement planning is like solving a complex puzzle. Every piece affects the others. Saving is one thing, but how you spend it can dictate how successful or soon you retire. This framework has four essential components. The first is the flexible withdrawal strategy that we discussed in the beginning. Instead of needing $95,000 a year from his $2 million portfolio, we structured his $1.2 million into three buckets with three different spending levels. This gave him options instead of rigid requirements. The second is tax optimization. See, having the right strategic tax plan can often save retirees thousands, if not hundreds of thousands over their lifetime. But it's something that needs to be managed and proactively looked after if you want to make the best long-term smart decision. The third is purpose planning. Jim defined what he was retiring to: time with grandkids, mentoring, traveling, and giving back. And this made the decision to retire exciting, not something that he was afraid of. So you don't need perfect market conditions, perfect health, or perfect timing. You simply need a flexible plan that works in multiple scenarios, and one, most importantly, that gives you the confidence to know that you're making the right decision. So now that you understand the real secret to retiring before 60 and how building flexibility through withdrawal strategy, bridge income, and proactive tax planning, most importantly, purpose planning enables early retirement that simply just chasing a number can't deliver. And you now know how to implement the framework that actually works. Because the truth is this, most people could potentially retire years earlier than they even thought possible. They just don't have the right strategy in place. And more often than not, they're measuring success by account balances when they should be measuring it by satisfaction, flexibility, and getting clear on what's truly enough. Because time is the one asset that you can never get back. Every year you work past your optimal retirement age or past your I already have enough age is a year that you can't reclaim. And the question isn't whether you can afford to retire early, it's whether you can afford not to. And the good news is you don't have to figure it out alone. If you want help building your early retirement strategy and figure out what's possible, click the link below to book a call where I'll be happy to walk through your specific situation and show you exactly how to plan for your early retirement. Thanks for watching. I'm Kyle Kuyat, and I'll see you next time.